macro currency signals.
Wealth does not disappear, it transfers. That is one of the most important lessons history teaches us, yet it is the one most people ignore when times feel stable. During every major monetary shift, the surface story is panic, volatility, headlines, and uncertainty. But underneath that noise, something much more calculated is happening. Assets are being repriced, balance sheets are being reshuffled. Purchasing power is migrating from one group to another. The system doesn't collapse in a single dramatic explosion, it adjusts, and that adjustment determines who advances and who falls behind. When monetary stress builds, it rarely announces itself with a warning siren. It begins quietly. Debt grows faster than productivity. Governments borrow to maintain stability. Central banks inject liquidity to smooth over disruptions. Markets continue functioning. Paychecks still arrive. Life feels normal. But beneath that surface normalcy, the foundation is carrying weight it was never designed to support. Over time, that pressure changes incentives. Savers begin earning less on their deposits. Asset prices inflate beyond fundamentals. Currency purchasing power erodes gradually, almost invisibly at first. People sense something is off, even if they cannot articulate it. The real turning point is not a crisis event, it is a shift in confidence. Monetary systems function because people believe tomorrow's money will hold similar value to today's money. When that belief weakens, behavior changes. Individuals spend faster. Institutions diversify into real assets. Capital begins looking for durability instead of yield. This is where wealth transfer accelerates. Those holding assets tied directly to currency promises often find themselves diluted. Those holding scarce, tangible assets begin to see relative strength. It is not magic, it is arithmetic. Before we go any further, pause for a second and drop a comment below. Tell me how much silver you're holding right now in your age. I'm genuinely curious to see how different generations are positioning themselves in this cycle. Now let's get back to the topic and connect this to the bigger picture unfolding in front of us. Throughout history, periods of excessive debt and currency expansion have always led to repricing cycles. Sometimes that repricing shows up as inflation. Sometimes it appears as currency realignment. Sometimes it manifests through financial repression, where savers quietly subsidize debtors. But in every case, there is a redistribution effect. The disciplined benefit from structural imbalances. The complacent absorb the cost. Wealth doesn't evaporate, it shifts toward assets that preserve purchasing power during instability. Today, the scale of global leverage is historically elevated. Governments are managing obligations that cannot realistically be paid down without growth that far exceeds current trends. Corporations have adapted to an environment of perpetual refinancing. Households have normalized debt as a permanent feature of life. This creates a fragile equilibrium, stable as long as confidence holds, unstable once doubt enters the equation, and doubt does not need to become panic to change outcomes. Even modest shifts in capital allocation can trigger large relative moves in smaller asset classes. The critical insight is that monetary transitions reward foresight more than timing. You do not need to predict the exact moment confidence shifts. You only need to recognize that prolonged imbalances eventually demand adjustment. When that adjustment begins, it often moves faster than consensus expects. Those positioned in durable, scarce assets benefit from repricing. Those anchored exclusively to paper structures often experience erosion. Wealth transfer is not emotional. It is structural. It reflects the reality that systems built on expanding obligations must eventually reconcile with limits. When they do, the market does not ask permission. It reallocates. And in that reallocation, new multimillionaires are created, not by chance, but by positioning ahead of the shift. The global monetary system is not collapsing. It is straining. And there is a difference. Collapse is sudden and visible. Strain is gradual and cumulative. What we are witnessing today is not a dramatic overnight failure, but a slow compression of flexibility. For more than a decade, every economic slowdown has been met with the same solution. Inject liquidity, suppress rates, expand balance sheets, and extend credit. Each intervention bought time. Each intervention prevented immediate pain. But each intervention also increased systemic leverage. We have not resolved structural imbalances. We have financed them forward. Debt has expanded faster than productive growth across nearly every major economy. Governments rely on borrowing not just for emergencies, but for normal operations. Corporations depend on refinancing rather than resilience. Consumers operate within a culture where leverage is standard and savings are secondary. This architecture functions smoothly as long as borrowing costs remain manageable and confidence remains intact. But once rates rise or growth slows, the margin for error narrows quickly. Servicing obligations becomes heavier. Policy options shrink. Stability begins to depend less on fundamentals and more on continued intervention. Central banks now operate within a tightening corridor. If they raise rates aggressively to contain inflation, debt servicing pressures intensify across governments, corporations, and households simultaneously. If they lower rates to relieve that pressure, currency purchasing power weakens and inflation risks reaccelerate. The balancing act becomes increasingly delicate. Every move has consequences. There is no longer a decision that fixes one problem without worsening another. That is the essence of structural stress, when trade-offs become unavoidable. What makes this environment different from prior cycles is scale. The absolute size of sovereign debt, corporate leverage, and derivative exposure means even small percentage changes translate into enormous financial strain. Markets are highly interconnected. One region's currency policy affects another region's trade balance. One country's debt crisis can ripple through global banking systems. Capital moves across borders at digital speed, reacting to perceived instability long before policymakers can contain it. In such an environment, confidence becomes the primary stabilizing force, and confidence is intangible. When trust in the monetary framework weakens, even slightly, capital behavior changes. Investors begin reallocating toward assets that are independent of policy discretion. They seek stores of value that cannot be printed or politically negotiated. This shift does not require panic headlines. It begins quietly, often beneath the surface of equity indices and bond yields. Hard assets begin outperforming over longer horizons. Volatility increases. Currency fluctuations grow sharper. These are not isolated anomalies. They are symptoms of a system adjusting to excessive leverage. The important point is not that collapse is inevitable. Monetary systems can stretch far longer than critics expect. The point is that the room for maneuver is shrinking. Policy flexibility is thinner. Shock absorbers are weaker. Each new disruption, geopolitical, financial, or economic, lands on a structure already under load. Over time, the probability of regime change increases, not necessarily a dramatic breakdown, but a shift in how money behaves, how inflation trends, and how assets are valued. In periods like this, capital seeks protection before clarity arrives. Markets move ahead of consensus. By the time stress becomes obvious to everyone, repositioning has already occurred. The global monetary system may continue functioning, but its stability is increasingly dependent on confidence rather than strength. And when confidence becomes the variable that matters most, tangible assets with intrinsic scarcity begin to attract disproportionate attention. Silver occupies a rare position in the global system because it exists in two worlds at the same time. It is ancient money, and it is modern infrastructure. Most assets belong clearly to one category. A bond is a financial instrument. Oil is an energy commodity. Technology stocks represent corporate innovation. Silver does not fit neatly into a single box. It carries thousands of years of monetary history, yet it is embedded in the circuitry of the digital age. That dual identity is not symbolic. It is structural. And when both sides of that identity activate at once, the implications become powerful. For most of recorded civilization, silver was used as money in everyday exchange. It was trusted not because of decree, but because of scarcity, divisibility, durability, and universal recognition. It facilitated trade across empires and continents long before modern banking systems existed. That historical memory does not disappear simply because currencies are now digital. In times of monetary uncertainty, societies instinctively return to tangible stores of value. Gold often represents concentrated wealth, but silver has traditionally served as accessible monetary metal, the bridge between large reserves and daily transactions. At the same time, silver is one of the most functionally important industrial materials in existence. Its electrical conductivity is unmatched among metals. Its thermal properties make it essential in high-performance applications. Its chemical stability allows it to operate in advanced medical, energy, and electronic environments. Modern civilization relies on silver in ways that are invisible to most consumers. Every smartphone, every advanced vehicle, every data center, every solar installation depends on small but critical quantities of silver to function efficiently. These are not luxury applications. They are foundational to the global economy. What makes this dynamic more significant is that much of the silver used industrially is not easily recoverable. It is dispersed in microscopic amounts across billions of devices. Unlike some commodities that are recycled at high rates, silver is often consumed in ways that gradually reduce accessible above-ground supply. That creates a steady structural draw on available inventory. Industrial growth does not simply use silver, it absorbs it. Now consider what happens when monetary stress intersects with this industrial demand. On one side, technology expansion increases baseline consumption. Electrification, renewable energy systems, digital infrastructure, and advanced manufacturing all require silver as a performance component. On the other side, investors navigating currency uncertainty begin looking for tangible assets outside the financial system. In that environment, silver is not merely an industrial input. It becomes a monetary alternative again. This is where the dual role becomes critical. If silver were only an industrial metal, demand would rise and fall with economic cycles. If it were only a monetary metal, demand would fluctuate primarily with financial sentiment. But because it is both, these demand streams can overlap. Industrial necessity provides structural support. Monetary demand provides surge potential. When both move in the same direction, supply constraints intensify rapidly. Markets often underestimate how small the physical silver market is relative to global pools of capital. It does not require a massive reallocation of wealth to strain available supply. A modest shift in investment preference can collide with ongoing industrial consumption and create imbalance. And when imbalance develops in a physically constrained market, price becomes the mechanism that restores equilibrium. Silver's dual identity is not a contradiction. It is a multiplier. It ties the metal to real economic function while preserving its monetary heritage. In periods of stability, that duality may seem irrelevant. In periods of systemic stress and technological expansion, it becomes decisive. One of the most misunderstood assumptions in commodity markets is the belief that higher prices automatically create higher supply. In textbooks, that relationship looks clean and efficient. In reality, especially in metals markets, it is slow, constrained, and often unresponsive in the short to medium term. Silver is a prime example of this structural rigidity. When demand begins to rise, whether from industrial expansion or investment flows, production cannot simply accelerate overnight. The pipeline from discovery to delivery is measured in years, sometimes decades. Unlike many commodities, the majority of global silver production does not come from primary silver mines. It comes as a byproduct of mining other metals such as copper, lead, and zinc. That means silver supply is tied to the economics of entirely different markets. If industrial demand for silver rises sharply but base metal demand remains weak, miners are unlikely to increase output simply to capture silver prices. The decision to expand production depends on the profitability of the primary metal being extracted. Silver, in many cases, is secondary revenue. This structural dependency limits supply responsiveness precisely when flexibility is needed most. Even in cases where new primary silver projects are viable, development timelines create significant lag. Exploration requires geological surveys, drilling programs, and feasibility studies. Environmental approvals and permitting processes can take years. Financing must be secured in volatile capital markets. Infrastructure, roads, energy supply, processing facilities must be built. Only then can production begin. By the time new ounces reach the market, the demand conditions that justified expansion may have evolved. This lag is not a flaw in management. It is inherent in the physical realities of mining. Meanwhile, industrial consumption continues steadily. Silver is used in small but critical quantities across electronics, renewable energy systems, medical technologies, and advanced manufacturing. These uses are not discretionary in the short term. They are embedded in supply chains. When production struggles to keep pace with ongoing consumption, inventories become thinner. What once appeared to be adequate stockpiles can quickly look insufficient when new demand layers on top. Now add investment demand into that equation. Financial capital moves at digital speed. Portfolio allocations can shift in days or weeks. If monetary uncertainty rises and investors seek exposure to physical silver, the influx of capital can be disproportionate to the size of the underlying market. The physical silver market is relatively small compared to global equities, bonds, and currency markets. It does not require trillions of dollars to create strain. Even modest reallocations can absorb available supply rapidly. When physical supply moves at geological speed and capital moves at electronic speed, price becomes the only balancing mechanism. Inventories tighten, premiums expand, delivery timelines extend. The market cannot create metal instantly, so it rations demand through higher prices. And price movements in constrained markets are rarely linear. They tend to gap, overshoot, and correct before stabilizing at a new equilibrium. This dynamic has repeated across multiple resource markets throughout history. Long periods of underinvestment create complacency. Production remains steady but uninspired. Then a catalyst, whether industrial expansion, policy change, or investment wave, exposes how thin the margin truly is. The adjustment phase is rarely polite. It is abrupt because the system lacks shock absorbers. Understanding this supply rigidity is essential. The question is not whether silver can eventually respond to higher prices. It can, over time. The question is what happens during the lag, during the window where demand outpaces available metal. In that window, repricing is not speculation, it is mechanics. Investment demand does not move in straight lines. It does not rise politely quarter after quarter. It moves in waves, powerful, emotional, and often synchronized. For long stretches of time, investors ignore certain assets. They focus on what feels safe, familiar, and recently profitable. Then something shifts, a narrative changes, a risk becomes visible. A confidence assumption breaks, and suddenly, capital begins flowing in one direction with surprising force. Unlike industrial demand, which tends to be steady and tied to production cycles, investment demand is psychological. It is driven by perception, fear, opportunity, and relative value. For years, investors can dismiss an asset as outdated, boring, or irrelevant. During those years, positioning remains light and liquidity appears comfortable. But once sentiment turns, the absence of prior positioning becomes fuel. When everyone tries to enter a small market at the same time, there are not enough willing sellers to accommodate them at previous prices. This is especially important in physically constrained markets. The global pool of investable capital is enormous. Pension funds, sovereign funds, institutions, retail investors, algorithmic systems. Even a small percentage reallocation from traditional financial assets into tangible alternatives can overwhelm available supply. It does not require a majority shift. It only requires a marginal shift at scale. When trillions of dollars are managed globally, a 1% move is not minor. It is transformational for smaller asset classes. Investment waves also feed on themselves. Rising prices validate the thesis for early participants. Those gains attract media attention. Attention draws in late adopters who fear missing the move. Momentum builds. What began as a rational hedge becomes a performance-driven allocation. As more capital flows in, liquidity tightens further, amplifying price volatility. In these phases, markets do not adjust gradually, they accelerate. There is also a technical dimension that intensifies these waves. Many investors hedge, short, or structure positions based on assumptions of stability. When prices break beyond expected ranges, risk managers step in. Short positions are covered. Derivatives are unwound. Hedging programs are adjusted. Each forced adjustment adds buying pressure. The move becomes less about fundamentals in the moment and more about positioning dynamics. This is how mid-cycle accelerations occur, not at the very beginning of a trend, but when recognition spreads that the old framework no longer applies. Psychology plays a critical role. Markets that have been calm for extended periods condition participants to expect continuity. Models are built on recent volatility ranges. Forecasts assume incremental change. When a wave of investment demand breaks those expectations, the reaction is not measured. It is urgent. Liquidity becomes one-sided. Gaps replace gradual moves. What seemed undervalued suddenly appears scarce. The key insight is that investment demand does not wait for universal agreement. It moves when a critical mass reaches the same conclusion at roughly the same time. In smaller markets, that synchronization has outsized consequences. A relatively small shift in sentiment can create disproportionate price reactions. Understanding this wave behavior is essential. Industrial demand may tighten supply slowly, but investment demand can ignite the imbalance instantly. When capital moves with conviction into a market that cannot expand supply quickly, repricing becomes rapid, and those positioned before the wave arrives experience outcomes that appear sudden to outsiders, but were structurally inevitable to those who understood the mechanics. Certain years become markers in financial history, not because of a single headline, but because multiple pressures that have been building quietly finally intersect. These are convergence years. They are not random. They are the result of cycles, debt cycles, monetary cycles, geopolitical cycles, technological investment cycles, reaching a point where postponement is no longer effective. The significance of 2026 is not mystical. It is structural. It represents the overlap of timelines that have been stretching for more than a decade. The global debt cycle is entering a phase where refinancing becomes more sensitive to interest rate levels. Years of low borrowing costs encouraged expansion across governments, corporations, and households. As that debt matures, it must be rolled forward under new conditions. Even small changes in rates translate into substantial increases in servicing costs when applied to large debt bases. This creates fiscal strain and narrows policy flexibility. When flexibility shrinks, volatility tends to expand. At the same time, geopolitical realignment is reshaping trade routes, supply chains, and capital flows. The global economy was built on efficiency and integration. Increasingly, it is being reorganized around resilience and security. That shift introduces friction. Redundancy replaces optimization. Costs rise as nations prioritize strategic independence over lowest price sourcing. These changes are gradual, but their financial implications accumulate. Inflationary pressures become more structural rather than purely cyclical. Layered onto this is a massive technological investment wave. Electrification, renewable energy infrastructure, digital networks, automation systems. These transitions are capital-intensive and resource-intensive. They require large quantities of raw materials and sustained funding. These investments are necessary for long-term productivity, but in the short and medium term, they compete for financial and physical resources in an already leveraged system. The competition tightens supply chains and increases sensitivity to disruption. Monetary authorities sit at the center of these overlapping forces. Their challenge is balancing price stability, financial stability, growth, and political realities, objectives that increasingly conflict. Maintaining tight policy to control inflation, risk-stressing debt, heavy balance sheets, loosening policy to relieve that stress risks weakening currency credibility. Each decision now carries amplified consequences because the system is operating closer to its limits. Convergence does not guarantee crisis. It increases probability, it increases sensitivity. In nonlinear systems, small catalysts can trigger disproportionate reactions when underlying pressure is high. A geopolitical event, a policy shift, or a market dislocation that might once have been absorbed smoothly can have outsized impact when multiple cycles are aligned. Markets tend to underestimate these alignment phases because daily noise obscures structural buildup, but when enough evidence accumulates, perception changes quickly. Narratives that once felt secure lose credibility. Asset relationships that held for years begin to break down. Investors reevaluate assumptions simultaneously. That is when repricing accelerates. 2026 stands out not because of the calendar itself, but because it represents the maturing of these overlapping pressures. Debt rollover dynamics, constrained policy space, resource competition, and shifting geopolitical frameworks are moving toward the same horizon. When cycles converge, the range of possible outcomes widens. Stability gives way to transition. Transitions are where wealth is reshaped, not evenly, not gradually, but decisively. Those who recognize convergence ahead of consensus are positioned before volatility expands. Those who wait for clarity often encounter price levels that already reflect the adjustment. In convergence years, markets move first. Explanations arrive later.